Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Kelly Ford Buckley, and she is the general partner at Edison Partners. And what I really loved about this episode is that Kelly has a ton of go-to-market expertise that she brings to investments that they make over at Edison. And Kelly and I had a great conversation on the order of operations on how companies need to approach value creation so that they're driving as much value as possible, along with minimizing the risk involved with investments that cause deals to fall apart. Kelly brings us insight that they don't really want to take on product risk or market risk, but they're happy to take on execution risk. She talks about how they go about making sure that the plans that they lay out in value creation, they actually go about executing them and mitigating a lot of the risks that they've identified on the execution side, but they don't really want to focus on fixing problems on the market side or the product side because they are just heavier risks to take on as an investor. And so when we talk about the execution side, Kelly brings a lot of detailed perspectives on how Edison brings their team and their operating partners and how they actually create a ton of enterprise value for the companies that they're investing in, along with making a lot of these essential trade-offs that are necessary, that you need to prioritize the right initiatives to create as much value for these companies as possible. So I think there's a lot to learn from it, especially as you're thinking about what type of risks you take on with your particular investments, because I really like that perspective from Kelly, because execution risk is something that we can control, especially after the capital has been deployed. You can figure out, okay, a company's marketing is not great. Okay, well, here's how we're going to solve it. We're going to either hire a new CMO, or we're going to bring on a partner like How to SaaS, or bring on other vendors to support that, or we hire additional headcount inside the team or make some adjustments. And then from there, you execute, right? Whereas product risk and market risk is just harder to kind of get rid of. So I thought that was a really interesting insight, and I think it applies to all areas like product and sales and customer success and everything else that goes into creating value for companies. So with that said, I'll leave you to it. Enjoy the episode. All right, Kelly, welcome to the show. How's it going?
Going great. Thanks for having me.
Yeah, excited to have you on. So why don't we start with your role and Edison, and then let's go from there.
Sure. So Edison Partners is a growth equity firm. We've been around for 39 years, investing in high growth, mainly software companies, vertical software businesses located in secondary markets. So we prioritize between the coasts, and the majority of our portfolios outside. We don't invest in Silicon Valley, and majority of the portfolios also outside, New York, and major markets. We are, we make minority and majority investments. Companies are typically 10 to 30 million revenue at the time of investment. And our checks are 15 million plus. And we're we're very engaged as investors. Our team is a pretty diverse mix of both longtime investors as well as operators, former operators like myself. So I joined the firm almost 11 and a half years ago. Spent 20 years operating primarily in go-to-market roles in high-growth tech companies that look a lot like the companies we invest in at Edison. And one of those companies was actually an Edison company. So that's how I got to know my now partners. And they recruited me over as the company was making a strategy sort of shift and evolution from venture to growth. So we started on that journey with Fund 8, which was 2015 vintage. And I joined in 14. And now we're investing out of our 11th fund, which is essentially Fund 4 for our growth equity strategy. And I've worn multiple hats here. I started and built out Edison Edge, our value creation platform, started taking boards, putting capital to work. I focused mainly on vertical software and in fintech as a specialty as an investor, and still very much involved, though I was sort of employee one on our value creation platform, building it out. And now we have lots of resources, doing it, but I like putting the operator hat on when I can. So,
And what would you say really separates out Edison from its counterparts or other firms that are chasing similar investments? Like, what is really your secret sauce?
I think the domain, it's probably a couple of things. I'd say the domain expertise vertically, where in the sectors where we invest, even prior to becoming a growth equity investor, when we were doing venture deals, it's the same industries. So, there's kind of a long tenured team with deep domain expertise in the verticals where we invest. I'd say the stage where we invest is very specific, and, what it takes to accelerate and scale growth for this growth stage. And that goes hand in hand also with the operating chops of our team and the way we work with our companies. I think pound for pound, we invest more in value creation than most firms and funds of our size. And we don't charge for it. It's part of our formula. We know it works, and it's it's of no cost to the companies we work with.
Yeah, and so talk about that piece. Like, just expand on the verticals where you feel like you add the most value or where you're focused, and then the stage of businesses where you specialize or you feel like you can add the most value to these companies.
Yeah, sure. So, vertically, we've been investing in fintech, from office of the CFO to payments technology to wealth and trading and democratization of financial services sort of broadly, so various themes within fintech and the evolution of all of those markets for 25 plus years, 30 years. So my partner Chris always says, like, we've been doing fintech since before fintech was cool. So, we're deep in fintech, also healthcare, IT, and we don't invest in life science or devices or biotech, but healthcare technologies, software, essentially that sells to payers and providers. And that also, it's not uncommon to find an intersection between fintech and healthcare technology and where we invest. And then otherwise, we're in vertical SaaS generally. We like specialized supply chain, technologies. We like anything that's digitizing critical infrastructure for the United States, whether it's around water or energy or supply chain, frankly, 911, security and safety oriented technology that's, powering the next generation of infrastructure for America. These are all categories where, we go really deep and have had, decades of experience investing in.
And on the value creation side, as you're coming into these companies, and are you building out standardized processes or benchmarks or frameworks as ways to help these companies and create value across the board as you start to kind of recognize some patterns that are the same? Or is it more about the approach? Like how do you address those types of opportunities when there's potential similarities between these investments?
Sure. We have 5 centers of excellence. So we go pretty deep on go-to-market, product and tech, leadership and people, finance, and then just broadly like good governance. And we have a framework for assessing the maturity and capability across those 5 areas. We often get to know the companies we invest in for 2+ years before we invest. So we get to know them early. So we've had some exposure to their evolution and where they've invested, what the level of operational maturity is, the quality of the team. But when we're really, sort of post-term sheet, really digging in during diligence, we evaluate the maturity and the capability across each of those 5 areas. It's quantitatively driven based on criteria of key components of, let's say in go-to-market, components of the strategy, components of the position in the market, different components of how they plan and perform, and also processes, and then people, org design, and the capability of the teams. So all of those things are evaluated and scored. And then we output based on the score, plot them on a maturity scale. And based on where they are and based on the investment thesis in terms of where is value creation, where do we think it's going to happen and where does it need to happen, we'll marry that investment thesis with the value creation plan to prioritize the key items to optimize, or in some cases, fix or build or create or establish if it doesn't already exist.
Mm-hmm, mm-hmm. And walk through those quantitative areas. Just I think this is a great place to kind of dig into. You mentioned the 5 biggest areas you look at. You said go-to-market, product, governance, finance, and leadership. Is that right? So help us understand kind of what you're looking at quantitatively to assess the maturity level, and then how do you figure out what next steps would be?
Sure. I mean, it's by center of excellence, right? So for go-to-market, there could be 30 to 50 areas of assessment and that scores are applied against. And as an example, let's say the go-to-market model and the sales dynamics, right? So is their approach aligned with what buyers in each segment of that they're targeting need to make a purchase decision? Like, is their model and their motion and, their strategy and therefore model and motion lined up with the level of complexity that their ICP comes with, right? And also aligned with the willingness to pay, the economic value of a deal or that ICP, right? So we'll look at, what kind of specialization they have in their, vertical sectors or segmentation. We'll look at sales cycle dynamics. We'll look at, is there a channel involved, partners at all? We'll look at the average deal sizes by segment, by sector. We'll look at win rates, right? So we also look more deeply at a lot of other unit economics as we contemplate strategy and planning. But based on the answers or the complexion of the model and the motion, like they think they're going after this ICP, and the go forward strategy and use of capital is to double down or diversify here or there, where we're looking for proof of repeatability and hopefully predictability in the business. And if we're not seeing that, your score is going to be low on how your execution is lining up with the model and the needs of what the model needs to look like to address what you are stating your ICP to be, if that makes sense.
We'll get back to the show in just a moment, but before we do, one of the most common and important value creation levers that we hear about on the show from private equity investors and our own PE partners is go-to-market. Yet, when these same PE partners bring us into their portfolio companies or new target investments that they're exploring, we find that the marketing function is quite immature, underutilized, and underoptimized. And so that's a huge opportunity that we see inside these companies. And if you have a portfolio company that you feel like could scale a lot faster to drive more pipeline and revenue, or you're looking at a new investment where you feel like that could be core to your investment thesis, well, we'd love to explore that with you and figure out how we can partner with you to drive more enterprise value creation on the marketing side, similar to the way that we've done with major PE firms like TA, Updata, HG, STG, and many more. At this point, we've done hundreds of engagements across hundreds of industries and verticals, and we have a ton of benchmarks and frameworks that we bring to these engagements to help you drive as much enterprise value as quickly as possible. So if that sounds like something that you might be interested in, you can just email me directly at shiv@howtosaas.com or go to our website and schedule a demo, and we'd love to speak with you about it further. And now with that said, let's get back to the show.
Totally. Yeah, that's one of the things that we talk about with our clients and private equity firms and portfolio companies that we work with, is just that you can have, let's say, a high ACV and limited total addressable market that you're going after. And in those cases, the companies are not investing enough to do one-to-one marketing or account-based marketing or partnering with sales in order to reach out to those companies. And on the flip side, if you have a company that is more transactional, if they try to go to customized in their outreach, like there's a mismatch and the go-to-market is not aligning, you end up spending way too much on acquiring customers. So I guess my follow-up to this would be that what are some of the areas that you're seeing when you're coming in and you're running this type of an assessment? And I think it's great that you are doing that and trying to scorecard and figure out where the areas of strength are, what the gaps are. What are the biggest areas of improvement that you see, or even red flags that you're spotting that may potentially like make it that you can actually invest, or they become the first areas that you're actually investing into to improve those businesses?
Yeah. I mean, it's not uncommon. I would say it's very common that when we're investing, if there's capital going to the balance sheet, which there almost always is, the company's looking to diversify. And maybe they've got some early proof of the ability to go into a new vertical or move from mid-market up to enterprise or SMB to mid-market. Maybe there's multi-product, multi-channel. So there's an element of, does the business have the muscle built around multi-threading in go-to-market or just across the business in general? And that is, usually we do see that they do have some element of that. But if they've been single threaded, like one product, one customer profile, one segment or sector, and they haven't yet proven they can multi-thread, there's huge execution risk in that. And that would be a warning sign. I mean, we don't take product risk or market risk in our deals. We take execution risk. So then it's, okay, well, what kind of execution risk would we be comfortable with? To your point, like, where is there opportunity, value creation opportunity, even if you have to optimize something versus, a real warning sign where you're just not going to, pay that enterprise value or lean in because it's just too much execution risk. I have a lot of appetite for transforming a pricing model or a business model. Like, I can see something so clearly and say where some investors might say, oh, that's like a pivot or that represents too much risk. There are signs and there are signals where I could just see so clearly that moving from a usage model to, a subscription model or transactional to subscription would make so much sense. And you could do it with relatively low risk. I also just personally have helped a lot of our companies with that successfully. So I'm not afraid of it, even though for some it may feel like, whoa, that's transformation or that's a pivot. It's not. So I would be very comfortable attacking that opportunity for value creation where we might have real concern on taking on a risk, even if there's low-hanging fruit to fix, say, a retention issue. It's usually multifaceted and can run deep with it, the metrics are telling you that. And, that tends to be a big obstacle.
Yeah, I like what you said there, which is that taking on product risk or market risk is much more unlikely for you, but taking on execution risk is something that you're willing to do because the X factor there, they're way more controllables in that type of an environment. Whereas, for example, if there's a retention problem, you may have an overall product market fit issue. You might need to do a bunch of development to get to a better place. But on an execution side, there's a lot more levers that you as the investor can actually pull.
Yep, absolutely. I mean, we're just thinking of a couple of other quick examples too, where value creation opportunity versus kind of that warning sign and the high risk sign, does the ELT, the executive team, are there a couple of roles that you may need to top grade or fill? Like there's a gap, like that's okay, right? Like, okay, you've gotten to this point and you haven't had a complete ELT, no big deal. But if like the entire ELT hasn't done this before at this stage, like that's a huge problem because you just can't move fast enough when you're like top grading an entire team. And then I'd say another point, I mean, just goes back to the multi-threading piece and having the muscle. Like if you're moving up market to enterprise from mid-market, and there's a lot of good signals that you could be successful doing that with some investment and additional focus, that's not that much of a stretch using our capital to do that. No big deal. But if the company's coming in saying, oh, we've been successful with enterprise and mid-market, or and we actually now are going to introduce a PLG motion that we've never done before, but we're confident that we can pivot or evolve in this direction. I mean, PLG requires a lot of experimentation, a lot of time, and it tends to be capital intensive. So if you're having success, you have reasonable repeatability in the business and mid-market, maybe even in the enterprise, or even frankly in SMB, but it's still deal sizes that justify talking to a sales rep. Like, can you complement that with PLG? Sure. But if the growth strategy is to go kind of all in on that and the capital is supposed to be, applied to that, or that's what the team is proposing, like that's huge risk.
Yeah. I think that's a great insight because in a lot of cases, ideas seem good on paper, but then when companies try to become something that they're not, and they're asking you as the investor to take on that risk, it kind of changes the return profile of an investment like that. So how do you prioritize there? Because companies always have all kinds of great ideas, and you have to kind of really be focused on your value creation plan. So do you have a framework for narrowing down which opportunities do make sense to pursue versus others?
Yeah, we do. So when we go through, so for a new investment, and we go through diligence and we run these maturity assessments and the scores come out, and there's always more to do. Like, you really do have to prioritize. Like, you can't paralyze a team post investment. The whole idea is to get a fast start and focus on the right things. I think the prioritization becomes easy. There may be a lot of things to do. There's a first 180-day plan and there's a second 180-day plan. And then frankly, if there's a follow-on investment, 18 months, 24 months, whatever it is in the future, or M&A you're doing, there's another first 180-day plan, right? Like we're not just scoring this at the initial investment, one and done. It's engagement and progressing the maturity of these functions and the team and the capability and the result over the life of the investment. So from a prioritization perspective, it goes back to, okay, well, what are we assuming in terms of our expected case outcome and optimistic case outcome? And we work back from that in terms of what the revenue growth is and, expense profile of the business and is going to be. I look first through the lens of, if anything needs to be fixed or optimized, it's the things that would slow us down, things that are preventing getting a fast start post-investment. So any sales and marketing misalignment, right? Like you brought up a good point around, kind of account base being I think, I don't know if you use this word, but like just being sniper focused, right? We're investing in vertical software businesses that are usually targeting large, mid-size and large companies. We don't have a lot of SMB. We have a little bit, but not a ton of like high velocity SMB motion in our portfolio. You define your ICP. You need to be sniper focused, not casting wide nets. Otherwise, your sales and marketing is just going to be inefficient, right? So it's not uncommon though. You see marketing on an account-based journey and sales territories are loosely defined, right? Like, what are we doing? Like, that's misalignment. Or there's a lack of shared goals between marketing and sales, or marketing's not measured on the ultimate outcome. It's just passing over something that may be qualified to the early stages of a sales pipeline. So really getting the interlock in place and that alignment on motion and metrics is super important. And that can really be in the way of getting that fast start post-investment. So we'll absolutely prioritize that.
Yeah, I think that order of operations is just so important. What we've seen in the work that we've done with PE firms, and especially on the go-to-market side, is almost like as a baseline, starting with what have you spent on historically, what's worked, what hasn't worked. And in a lot of cases, and I'm sure you've seen this inside of your companies, you can have a $50 million business or $100 million business, and they don't really even have their data in order. And so getting that organized to a point where you can at least say, okay, we're spending $5 million or $2 million on marketing or on sales, and here's the return that we get on that. Here's our efficiency. Here's what we should scale up. Here's what we should scale down. And just that step back and figuring that out can reveal a lot of insights into where the company should focus going forward. And then as you identify what's working, then you can start to look into, okay, what are all the net new things that we can do?
You need to adjust, right? To drive. Yeah, the numbers absolutely drive it. I think the example I just gave was, certainly qualitative, where you can just see they're misaligned in motion. And it's a big part of our job to surface the data to show them that if you get alignment, you can move, accelerate the sales process by X. You can improve your CAC and your CAC payback by Y. You can, right? So yeah, it's not uncommon that we're having to sell the priorities with metrics to help them see, yes, this is why you can't keep doing things the way you're doing them.
Yeah, and even before you go in and expand your base of all the things that you are doing and start a new initiative that's going to require different sets of resources or people or campaigns and projects, like, have we really nailed down our core business and core set of activities, and are we doing that to the best of our abilities in terms of how strong the go-to-market engine is? And at least we found that a lot of companies are not close to maxed out, and everybody's kind of drowning in opportunity. So it's almost like you risk getting distracted before you actually get really good at the things that made you a great business that's worth acquiring in the first place.
Yeah, absolutely. There can be a back to basics, like slow down before you speed up, and make sure we all understand where we are and what we're building from. It's interesting too. Like it's not uncommon that after, especially some of our best companies, the larger PEs that play above us come in and we'll get some partial liquidity, but we roll with them and we remain on the board. And we've witnessed where that next level of value creation capability at other firms come in, which is certainly valuable. Big teams, lots of capability and lots of engagement, deep engagement in the company, swim lanes with all the different priorities post-investment. It can pair, like, especially in recent years where sort of these mega funds come down into, they might pay up and come down into slightly less mature businesses, and it can paralyze a business.
For sure.
And we've seen growth slow as a result. So the prioritization is key. The adapting and tailoring what we're looking to optimize or establish or fix so that the business can keep doing what it's been great at and what's been driving the growth, while diversifying into that next market or optimizing how customer success works, or whatever the initiative is. You got to let the business continue to do what it's so great at, and by adding new things or fixing things that could be optimized, you can't paralyze the business. In parallel.
Yeah. Are you seeing that even more so now? Because with a lot of our clients and private equity firms, we're finding that, especially in the last, I would say 12 to 18 months, as growth has slowed in the macroeconomic environment for a lot of companies, it's even more important now than ever, where a lot of companies are maybe closing fewer deals or they're trying to be more efficient with their spend, that this topic of focus is more important. Where, let's say 4 or 5 years ago, when money was easier to find, like, you could be doing more stuff and it looked like you were being productive. And now those same companies are being forced to make sacrifices. Maybe they've made some headcount adjustments or reduced spend in other places. And it's almost like coming back to the core business and back to basics almost.
Yeah, 100%. Companies have had to get religion on bottom line. The good news is the companies that are coming to market to fundraise, or founders looking to sell, or whatever it is, they tend to be businesses with healthier profiles than they were, 18 months to 2 years ago. So maybe the top line, they're not growing 60%, they're growing 35 or 40, but they're doing it on break even. And we've always prioritized capital efficient businesses. If my view personally, I won't invest. Some of us here will say, like, if they've raised more than 2x their revenue, that is capital inefficient. I personally, if you've raised more than what you're generating in revenue, and I'm saying like GAAP revenue, then you're capital inefficient. And I I won't invest in those businesses. They can have low losses. I'm okay with that for a while we accelerate EBITDA loss, but we have to see a line of sight to break even to profitability, and capital efficiency at investment and capital efficiency at exit on the way, and a good portion of the journey on the way to exit is really important. And the good news is, because of the macro, companies have had to get religion on how to do more with less, be more focused, and we're now seeing that in our pipeline, the deals we're looking at, which I really appreciate, because there had been a lot of capital raise and a lot of inefficiency, and really venture profile companies with a ton of product and execution risk coming to market. And because their growth was so great, you can be sort of dazzled by that, but there's so much to dig into to figure out how to right size it and continue to grow and take advantage of the market opportunity, but do so on lower losses or no losses. And it's been a real shift for companies. And I think it's actually why also we focus in secondary markets. Like, the founders and executive teams with businesses in places like Birmingham and Indianapolis and Grand Rapids, Michigan, and whether there once was less availability of capital, or just the mindset is build a great business and focus on the business and not becoming a professional fundraiser, is the mindset of the founder and CEO that we want to back. And they tend to exist in those, outside of places like Silicon Valley and New York and Boston. And that's been true historically. I think that remains true now. But it has been, I think a lot of companies had a wake-up call where they realized they wouldn't be able to sell their business at a price that they'd want, or raise capital from maybe the right investors and at the right price, because they were just burning and it looked too venture-y and there was just too much risk.
Yeah, I totally agree with the idea of the secondary markets. Like we know a lot of people in Birmingham and Atlanta and Norfolk and a lot of these kinds of Provo, where there are great companies, but there's much less capital per capita, if you will, number of companies that are out there. And so those companies are forced to build for profitability and make a lot of those trade-offs that some of these companies that are raising venture capital didn't have to make, at least in the earlier days. So
the media, still, the press celebrates, and even some investors, those who have raised the most money, and it doesn't mean it's a healthy business or they're going to have the best outcome. It puts that much, it's like growth at all costs and too big to fail. There's just too much of that. So
yeah, totally. And also it one of the major issues right now, and we've had so many investors come on this podcast and talk about this, is that the secondaries market for PE funds has really ramped up, because these funds need to return capital to their LPs. And then you have these assets that are worth more on paper than they are actually worth on the market. And it's creating this mismatch, and the PE firms are unable to exit these companies.
Yeah.
And so they kind of need to leverage.
Whole periods are being extended for sure.
Yeah, exactly. And so that kind of creates a bit of a problem for the funds, because they do need to sell these companies at some point.
In order to raise their next fund.
Yeah, exactly.
Yeah.
Exactly. To show performance and return capital and all those things. What do you think about the AI side? Because I feel this way about AI as well, because it is the hot button topic in private equity, and every portfolio summit that we go to or speak at, like everybody's kind of talking about AI. And one of the things that I notice is that a lot of the companies obsessing about this can easily also get distracted by AI as like the new shiny thing that they should focus all their attention on. And then meanwhile, some of the fundamental things that we've been talking about are not in a great place. Yet at the same time, yes, there is an opportunity there. So you kind of have to capture it, and there are some trade-offs to be made. So how do you look at that for your portfolio companies?
Well, there's two ways to look at it. There's the operationally, internally, like how is AI being adopted and successfully to drive usually meaningful efficiency, really. It's just about time. And, we see strong use of AI in, the engineering organizations in terms of reducing time to market in a big, big way on, just accelerating roadmap and product delivery. And that, they test it, they measure it, and then if it's working, they go all in on it, right? So you have to experiment and see what is this really getting you. I think in sales and marketing, there's the tech stack in sales and marketing is it's starting to, and it will add more efficiency, capabilities using AI that will drive efficiencies there as well. But it's not going to do anybody's job for them necessarily. So I think it's, experiment. I think there's a lot of pressure on the tech providers it's not AI for AI's sake. And then that flips it the other way. Like all of our companies are doing something with AI in building it into their product. Their customers expect it, but it has to be something that's useful, will be adopted, can show the result. It's not just AI for AI's sake. So as the tech industry it's an efficiency play first, where folks are going to have the aha and see the result. And then, it'll go from there. We're not prescribing. I mean, there's definitely been things that have come up, like when we do diligence on a new investment and say like, oh, wow, you're not using AI for that. You should. And here, go talk to this company who's doing it and it's going to change your life, But I'd say operationally, there's a lot of low hanging fruit. I'd say in the product, in terms of what market you're in, got to be something that's like really easy to adopt and is aligned with your customers' outcomes that they're trying to drive with your solution. And anything else is just noise and checking boxes and something you're trying to put on the homepage of your website,
Yeah. It almost feels like every company's homepage now has the word AI in it, even if it's nothing that the customer is actually using. So
yeah, and the investors expect it, right? Like, what are you doing with AI? I mean, we just had 2 companies present to IC last week, 2 new investments that were approved. One of them was one I'm leading, and they all put in their decks, and it's part of the narrative, like what they're doing internally, what they're doing with their product with AI. I didn't have to ask them to do that, but it would have been a gap if they didn't include it, and our team expects it,
Yeah. It's almost like a permission to play type of thing now, more than actual value. So, and I think some of the stuff that you said earlier about getting some of the fundamentals right, like retention and making sure that you have a sticky solution and all this, and don't have product risk or market risk. I think those precede things like this. So that's great insight. As we're coming up on time here, Kelly, what's the best way, if somebody's listening to this podcast and they want to get a hold of you or Edison, what's the best way they can get in touch?
We're, edisonpartners.com is our website, our team page, where our contact info is out there. So email's there, and I respond to every email I get. So
awesome. Yeah, we'll be sure to include that and all the links in the show notes. But with that said, Kelly, thanks for coming on and sharing your approach. I actually wish we had more time to dive deeper into some of these topics, but appreciate you sharing your wisdom. I think a lot of people will learn a ton from it. So thanks for doing this.
Great. Thanks for having me.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosaas.com. And third, please buy a copy of my new book, Exit Ready Marketing marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.